I'm 28 years old and my net worth is over $500,000, but I still rent a one-bedroom apartment. My base rent is $1,389, and with the specials that my building was running, I'm effectively paying just $1,160 a month. And before somebody comments, Dave, sounds like you're just throwing away $1,200 a month, let me show you why I don't think that's true. Because sure, buying a home can absolutely help you build wealth, but just because you're making mortgage payments does not mean that all of that money is actually building equity. And homeowners, they have plenty of costs that they never get back too. So, to prove my point, we are going to run the actual numbers on a $400,000 house. We'll figure out how much cash you really need before you buy, and then get to the one number that I think matters more than your mortgage rate. And by the end of this video, you'll know how to actually compare the cost of renting versus buying for yourself. Point 1. Count what you actually don't get back. All right, let's start with the sentence that we've all heard: renting is throwing away money. I do not agree with that. When you rent, you're paying for a place to live, sure, but you're also paying for flexibility and you're paying for somebody else to take on a lot of risk and responsibility that comes with owning the property. That is a service that you're paying for. But here's the part that people tend to forget. Homeowners throw away money too. Not literally, but there are plenty of costs associated with owning a home that do not build equity. And this is the shift that I want you to make for the rest of this video. Do not compare rent to a mortgage payment. Compare the money that you don't get back as a renter to the money that you don't get back as an owner. For renters, the unrecoverable side is pretty simple. You've got your rent plus renter's insurance, which is usually pretty cheap. For a homeowner, the list gets a lot longer. You've got mortgage interest, and remember, only the principal portion of your mortgage payment builds equity. The interest is just the cost of borrowing, and you do not get that money back. And that is just the mortgage. Then you've got things like property taxes, homeowner's insurance, PMI if you don't have enough down, HOA fees if you have them, maintenance and repairs, potentially higher utilities, lawn care, pest control, snow removal, and depending on the house, you could also have things like flood insurance or an HOA special assessment. And then there's the cost of actually buying and eventually selling the house, but we're gonna come back to that later because that deserves its own section. Out of the whole list, maintenance is probably the one that people underestimate the most. Fannie Mae's guidance puts it somewhere around 1 to 4% of the home's value per year, with older homes potentially needing you to budget toward the higher end. But personally, I would not blindly slap a generic percentage onto every house. A brand new home and a 50-year-old home with an old roof and an HVAC system hanging on for dear life are obviously not the same thing. So look at the age and condition of the actual house you're buying and then build a realistic maintenance number into your math. Because the mistake that I see people make all of the time is this: they compare $1,900 in rent to a $1,900 mortgage and go, well, buying is obviously the better answer. Not necessarily. Those are not the two numbers that we should be comparing. So here's your homework for this section. Write down what you're paying in rent. That's one side of the equation. And now we're going to build the homeowner side using a $400,000 house and run the actual numbers line by line. Real quick, before we run the numbers, if you're trying to figure out where buying a house even fits with your emergency fund, paying off debt, and investing for retirement, I put my entire order of operations into a free guide called the Wealth Building Blocks. It walks you through the 5 steps that I'd use to build a strong financial foundation. And it also includes my zero-based budget template, debt payoff calculator, and net worth tracker. It's completely free and linked in the description, but now let's actually run the numbers. Point 2. Run the numbers on a real house. All right, let's use a $400,000 house, which is actually a little below the national median home price right now, so I think it's a good example to use. Let's say we put 20% down, that's $80,000 up front, which means you're then financing the other $320,000. And as I'm filming this, the average 30-year fixed rate mortgage is about 6.69%. At that rate, your principal and interest interest payment comes out to be about $2,063 a month. But remember what we just talked about. That entire $2,063 is not building equity. In the first year, on average, about $1,775 of each payment is going towards interest, and only $287 is going towards principal. So over that first year, you'll make roughly $24,750 in mortgage payments, but only about $3,450 of that is actually building equity. That, my friends, is amortization. Early in the loan, your balance is still really high, so most of your payment goes toward interest. Over time, that starts to flip. But in year one, roughly 86% of your mortgage payment is money that you're not getting back. And remember, that's just the mortgage. Now we start adding in everything else like property taxes. Those vary a ton depending on where you live, but for this example, let's use 1% of the home's value. That's $4,000 a year, or about $333 a month. Then we have homeowners insurance. We'll use $2,500 a year, or about $208 a month. And then maintenance, we'll use 1% here too and assume that it is a relatively newer house. Still, that's another $4,000 a year, or about $333 a month. Add all of that together and we're at about $2,938 a month. Of that, only about $287 is going towards your principal and building equity, which means roughly $2,650 every single month is an unrecoverable cost, or about $31,800 a year. And that is before HOA fees or any of those other homeownership costs that may apply. But here is where I think this gets really interesting. If we take that $31,800 and divide it by the $400,000 price of the house, you get about 8%. So for this specific home with 20% down at today's mortgage rate, roughly 8% of the home's value every year is going towards the costs that don't build you any equity. Now, please do not take that and turn it into Dave says owning a home costs 8% a year. That's not what I'm saying. Change the mortgage rate, taxes, insurance, maintenance, or down payment, and that number changes too. And the down payment alone can move it a lot. If we take the exact same $400,000 house, but instead of putting 20% down, let's say you put 5% down, you're now borrowing $380,000 in the first year. You're paying about $25,300 in interest, and because you're putting less than 20% down on a conventional mortgage, that's also going to add $202 a month in PMI. If we run the same math again, your unrecoverable costs now move from roughly 8% to about 9.6% of the home's value. The same house, the same rate, just a different down payment. Now go back to where you wrote down your rent, because this is the comparison I actually care about, not rent versus mortgage. No, your unrecoverable cost of renting versus your unrecoverable cost of owning. On this $400,000 house, we calculated about $2,650 a month on the ownership side. For some national context, median rents right now are about $1,550 for a one bedroom, $1,670 for a two bedroom, and just over $2,000 for a three bedroom. Mine, again, $1,160. Now obviously, a rental and a $400,000 house are not always going to be apples to apples, but I do think that those numbers give you some perspective on just how different the monthly unrecoverable costs can be. When you run this for yourself, don't use my rent or even the national median. Look at what you're actually paying or what a comparable rental would cost in your area and put that number next to the unrecoverable costs of the house that you're considering. That is the comparison that actually matters. And again, this is just a snapshot. At a 3% mortgage rate, this math would look completely different. So do not run this calculation once and assume that you've discovered some permanent rule about renting versus buying. Run it on the house you're actually considering with the numbers that exist when you're actually ready to buy. So here's your homework. Find a real listing in your area and run the same math. Mortgage, interest, property taxes, homeowners insurance, maintenance, and PMI and HOA fees if they apply. Add up all of what you don't get back when you own a home, and then compare that to what you'd actually spend renting. But no matter what way that goes, do not go out and buy yet, because there's another question that you have to answer before you buy. Can you actually afford to become a homeowner? Because you can run all of this math, decide buying makes sense, and still not have enough cash to comfortably make the move. So next, point 3, decide what you need saved before you buy anything. So how much money should you actually have saved before buying a house? Personally, I'd want at least 5% down, with 20% being ideal. Now, that's not a rule. There are loan programs that let you put down less, but the advantage of getting to 20% on a conventional mortgage is that you can generally avoid PMI. Remember, that was $222 a month. That does nothing for you. And you're also borrowing less, so in turn, your payment and what you'll pay in interest are both lower. All that said, I would not put 20% down if it wiped out my savings. Before I buy, I want you to have a fully funded emergency fund that's still there after closing. I want you to be out of high interest debt, which is any debt over 7%. And separately, I want you to have enough cash for the closing costs, moving expenses, and any immediate repairs or purchases that come with the house. Even though you might technically be able to afford the down payment, I don't want you to end up with just $500 in your bank account the day that you get the keys. Why? Because houses have a funny way of handing you expenses right after you buy them, and that foundation is what lets you absorb a broken HVAC or a plumbing problem without reaching for a credit card. Now let's say that you've saved $30,000 and you're planning to buy within the next year or two. Where should that money sit? For me, it's easy. It's a high yield savings account. The goal with short-term money is not to maximize your return, it's to make sure that money is actually there when you need it. And I would not put a house down payment into stocks or ETFs. While the market could hypothetically go up, it could also drop 20%. And I do not want, whether you buy a house or not, to depend on what the stock market is doing. So for me, my general rule of thumb is that if I plan to use the money within the next 5 years, that money is going into my HYSA. By the way, if you don't have a high yield savings account yet, I keep the ones that I actually use and trust on one page with all of the details, and I've linked that in the description. That way, you don't have to dig through 50 reviews to figure out which one is the best one for you. A couple of those are affiliate links, which means I may earn a commission if you open an account through them, but that is at no extra cost to you. All of these accounts are accounts that I'd be comfortable my mother using, so go check them out. All right, now that you know what owning actually costs, you know what you need saved before you buy, and you know where that down payment sits while you wait, there is one thing left, and it decides this whole question of rent or buy more than the mortgage rate, more than the home price, more than any of it, which brings me to point number 4. Point 4, decide how long you're actually staying. This is the number that I teased at the start, and it isn't a dollar amount or a percentage. It's how long you expect to stay in that home. And here's why I think it matters so much. Buying and selling is expensive, and those costs are almost entirely unrecoverable. On the way in, closing costs typically run about 2 to 5% of the purchase price, and on the way out, you've got your agent commissions, which average around 5 to 6% nationally, plus other seller closing costs. So round trip, buying and eventually selling, you're realistically looking at somewhere around 8 to 10% of the home's price. And on our $400,000 house, that's roughly $32,000 to $40,000 just gone. So for an example, let's use $36,000 since it's right in the middle of that range and see what happens when you spread that cost across time. If you move 2 years later, that's $18,000 a year, or another 4.5% of the home's value every year, stacked right on top of the 8% that we already calculated. If you stay 5 years, it's $7,200 a year, that's 1.8%. Stay 10 years, $3,600 a year, less than 1%. The same house, same rate, same down payment. The only thing that changed was how long you stayed. In general, you'll hear 5 years as how long you should stay, and I do think that that is a decent starting point, but there is no magic break-even year. Your actual break-even point could be shorter or much longer, depending on the mortgage rate, closing costs, maintenance, how much your home appreciates, and how fast rent rises where you live. So, like everything in this video, run the numbers for yourself, estimate your break-even point, and then give yourself some margin for error, because even after you run all of these numbers, these are still just projections. Nobody truly knows exactly what home prices or rent are going to do over the next 10 years. Now, I also want to be fair to home ownership, because there's some very real benefits to owning that do not show up in all the math that we just did. You're building equity, your home can appreciate, and eventually you own an actual asset. Plus, there are the things that are really hard to put into a spreadsheet, like stability, control, space, and being able to make the place actually yours. On the other hand though, renting does have a lot of advantages. Your rent can go up when your lease renews, sure, but if the HVAC dies tomorrow or the roof needs replacing, that's not suddenly a $10,000 problem landing in your lap. That is why I do not think renting versus buying is purely a financial decision. The numbers do absolutely matter, but so does what you actually want your life to look like. The mistake that I see people make is buying because they've been told that home ownership is always the financially superior decision without even asking whether they're actually going to stay long enough for the math to work. So here's your homework. Before you look at a single listing, answer this honestly. Where am I realistically going to be 5 years from now? Not where do I hope to be, where am I actually likely to be based on my career, my relationships, and my life right now. And if your life says, hey, it's time to buy, and you've run all the numbers and it still makes sense to buy that way too, the next step is to actually figure out what mortgage amount and rate you personally qualify for. Because remember, the national average that we've been using in this video isn't necessarily your rate. Your credit, down payment, and loan type can all change it. So I'll link where I'd start comparing mortgage options in the description. And just so you're aware, just like my HY essays, I may earn a commission if you go through that link, but that's at no extra cost to you. So no, I do not think renting is throwing away money. Sure, rent is a cost that you don't get back, but as you saw, owning has those costs too. The goal is to compare those costs honestly and then figure out what actually makes the most sense for your life. Now, do me a favor and comment 2 numbers. What are you paying in rent? And roughly, what would a comparable home cost where you live? Selfishly, I love seeing how that data plays out across the United States. And if you want more straight money breakdowns like this, hit subscribe, and then finally, click the video on your screen, because before you save a down payment, there's one step that I'd make sure you handle first.